Well, I think this is a very important breaking news. The inflation number is way below what the street was expecting at 5.88%. It's absolutely manna from heaven. The average on the street was running, the average guesses were running between 6.3 and 6.4. This is absolutely a number that's a good 0.5% or more below what the street was expecting. I can't remember when we last got such a favorable number, and this will of course mollify bond prices a goodish bit. We've got the industrial output data. Now that's not a very good number. The industrial output for October, which we were expecting about less than -1%, has come at -4%. So that clearly looks like a bad number. The industrial IIP is not an extremely reliable number. Nevertheless, it's directionally usually been correct. But this is a very, very disappointing number. I'll concentrate on the number which matters more, which is the inflation number, simply because policy is made on the basis of this inflation number. The monetary policy is made on the basis of CPI. It has to stay between 2 and 6%. And now, after 10 long months, we indeed have inflation below the 6% mark at 5.88. That's clearly a huge relief for the MPC and the Reserve Bank, because the expectation was it will come under 6% only in the next quarter, probably in March or February. The fact that it has come in advance, is going to be excellent news for the government and for the Reserve Bank. So that's an important achievement for the economy as well. I think tomorrow you should expect a rally in all interest rate sensitive stocks. This is very big, very big. The food inflation number has come in at 4.67%, and I'll just give you most of the other numbers that we care for. In fact, I can go one by one. Cereals is up 12.9%. That's big. But other numbers have gone down, obviously. Meat and fish up 3.87%. Eggs up 4.86%. Meat and milk and milk products up 8.16%. And then come the ones that are negative. Edible oils is -0.6%. I mean, that's a far cry from what it was in the first 2 quarters of the year. Then fruits, again, just about 2%. Vegetables, -8%. That's usually the case in November, but at the moment it's welcome, because vegetables was really hanging in as an important food item that was expensive. Pulses, 3% higher, 3.15 to be precise. Spices are up, but that's a small weight in the index. Prepared meals is again up 7.9, but again a small weight in the index. Food and beverages on the whole are up 5%. Then let's come to clothing and footwear. That's high at 9.83. Then you have miscellaneous or services. Services, household goods and services are up 7.6. Health is up 5.83%. Transport and communications is up 5.3%. Recreation and amusement 5.44%. Education 5.78%. And personal care and effects 7.03%. Chances are, going by this, the core inflation will be well over 6%, probably 6.1 or 6.2, and that is not a very pleasant number if it indeed comes well over 6%, because the Reserve Bank specifically mentioned in the previous policy that it is worried that core inflation is not coming down. They want it to come, of course, towards the 4% mark, but it's a fairly sticky number. So overall, good news at the headline at 5.88%. But core inflation, is my sense is a little sticky, but I'll give you the exact number in a bit. IIP numbers, as I told you, have come in as a major disappointment. But before I get to the IIP numbers, why don't I get the first comments on the CPI from my guests? I have Nikhil Gupta, the economist from Motilal Oswal Financial Services, Upasana Bharadwaj, the chief economist from Kotak Mahindra Bank, I think Aditi Nayar from ICRA, Rupa Regere of L&T Financial Services, and in a bit I'll also call Amandeep Chopra for his comment on the bond market. Rupa, your number 5.88 is a pleasant surprise?
Yes, it's definitely a pleasant surprise, because sequentially, Ministry of Consumer Affairs database showed that there was a significant sequential increase in the prices of cereals and some of the edible oils and onions, which is a commodity of mass consumption. So I would like to look at more disaggregated data to understand that exactly what has driven this fall. But it's a very, very pleasant number.
Yeah, I have a feeling vegetables has contributed in a big way. Edible oils, of course, has been steadily going down. And I would assume pulses. These three seem to have contributed. Upasana, any first thoughts? Is this a pleasant surprise for you? And from the numbers I read out, any first thoughts on what's brought this positive number?
Absolutely, Lata. Quite a pleasant surprise. We were at 6.39. So clearly a big drop there. Yes, definitely the drop is led by vegetable prices largely from what you just read out, the details. We were looking at a flattish month-on-month reading. So that clearly suggests the kind of fall that you have suggested. That is the reason, key driver, I would say. Oilseeds, pulses, fruits and vegetables. These were the categories which were showing signs of abating. And from the subsequent month, we were looking at a contraction, quite a significant one. But I think it's already come 1 month before in advance. And that is the key reason. My fear is on the core inflation side. I think some of the numbers you read out seemed a little more higher. I think it could be closer to a 6.3% or so, tentatively right now. But it's going to be marginally higher to the previous reading, probably.
Yes, the individual numbers are looking very big. So even my guess is somebody has to do the calculation and let me know. But I think the core inflation will be over 6.2, as you point out. Let me get to Nikhil. Nikhil, what are you expecting, therefore, that you're going to have a faster than expected fall in inflation? The end year inflation will be way below 6%?
Thank you, Lata, for having me on the show. So, Lata, before I get to my expectation, based on my numbers, core CPI, as per RBI's calculation, will be broadly flat at 6%, where it has been the last 2 months. But if we exclude pan and tobacco also from the RBI's estimate, it would have inched up from 6.2% last month to 6.3% this month. So we were expecting 6.2% headline inflation this month, and it has turned out below 5.9%, almost entirely because of food inflation, as you had hinted in your remarks as well.
Okay.
Going
Yep.
Sorry.
Go ahead.
Going about expectations. See, again, food inflation is extremely difficult to forecast, but as far as the historical trends suggest, it looks like headline inflation could be close to 6% over the next 2 to 3 months before falling close to 5.5% in March.
Okay.
This is purely based on food inflation, based on historical trends.
Got it.
But core inflation notably is expected to remain around 6% till March 2023.
Okay. Okay. So just to reiterate, CPI is at 11-month low at 5.88. We have not seen a sub-6 number since January. So that's a key satisfaction for the Reserve Bank, a key relief. Aditi Nayar, would you want to comment on the CPI number, or would you want to look at the inflation? I mean, the index of industrial output at -4. And the big culprit, again, are consumer durables and consumer non-durables. My God, this is a double-digit fall. Consumer durables down 15.3% and consumer non-durables minus 13.4%. Of course, all these are October numbers. The IIP comes 1 month too late. So your thoughts, Aditi?
Thanks, Lata. You know, as far as the CPI is concerned, our recent expectation was that for the rest of this fiscal year, CPI is going to range at 6 plus minus 0.3%. So hopefully after this surprisingly benign number, we're going to get more readings that are going to be below 6% going ahead. Although I won't rule out that we may have 1 odd month, which again inches up above 6% because of a base effect. On the IIP side, we had expected a contraction of 1.3%. And, you know, even though IIP, as you said, is very difficult to predict, it's not always a very, it tends to be a very noisy data set. But I think one thing we really need to keep in mind is that in the month of October, there were a lot of holidays, and this is factory output we're talking about. So if factories are closed, it has a major impact on the IIP growth numbers. And I'm not surprised that there is a contraction. We had penciled in a contraction. It's deeper than what we estimated, but then chances are we'll end up with a fairly strong bounce back in the month of November because of the reverse base effect. The factories were open for a larger number of days as compared to November 2021. And that's the kind of rebound that a lot of high frequency indicators are already showing us for the month of November. So while of course the IIP number is disappointing, I won't put too much weight on that being an enduring trend going ahead.
Okay. Well, actually, the September number has been revised slightly higher from 3.1 to 3.5. But this -4, how much at all will it get revised? It's a 26-month low on IIP. So this looks a little disturbing. And manufacturing has come in, I think, at -5% or so. I mean, it has to if you want a -4 number. -5.6 on manufacturing. And as I pointed out, consumer goods have taken the bashing. A huge double-digit mid-teens fall in both those numbers. But Amandeep, you hold the key to how the markets will react. This is a hugely positive CPI number. What do you expect?
I think with the markets, this clearly is a big positive surprise. The consensus was well above 6, around 6.3. And I think the lowest number that I recall hearing was, close to 6.1. So I think this number at 5.88 clearly has been a big undershoot. What's also important now is that if you recall our...
Yeah. Oh, okay.
Yeah. 6.6 average for Q4 December number would not be significantly higher either as well. So, yeah. So I guess the trend is positive for the markets. I'm sure there would be a bit of a bounce back. But I think we should also be cognizant of the fact that there are many other key events taking place this week. So, while there could be a bit of a positive move in the bond yields, but going ahead, I guess the focus will shift back to the Fed and, the US CPI data, which comes in tomorrow.
But what is your definition of positive? Do we go to 7.2?
Quite likely. I think it's possible that we could actually touch, the recent low.
Okay, that was even below 7.2 actually.
No, I mean the pre-policy levels, yeah.
Okay. Well, let me get an idea of whether now all of you are changing your idea as to what RBI will do in terms of future policy hikes. I mean, if you're already at 5.8, then does removal of accommodation go away in February? Is there a February hike? It looked like that when RBI announced policy on December 7th. So, Rupa, let me start with you.
Yeah, because if I go by the tone of the last policy statement, it was definitely on the hawkish side, even though two of the external members, recommended very strongly a pause, and they have been recommending it for quite some time. But I feel that, this sustained negative prints for because even GDP second quarter data, we saw that both mining and manufacturing sectors have posted degrowth. And now, as you rightly said, there is, this sustained tendency we have seen in consumer goods for negative growth. I think given the fragility of demand, because demand has already started slowing down, I feel that the actual pause will come before what they might have earlier planned. February, they will definitely undertake a rate increase. But after that, I feel that they will not just take a pause, but also give some kind of a guidance on liquidity so as to reduce the nervousness in fixed income markets.
Oh, okay. Upasana, I think the core inflation has come in at 6, if I'm not mistaken. Somebody has messaged me. So if we go with 6, in any case, my sense, Upasana and everybody, is that the Reserve Bank usually knows the number by the last day of the month. They may not know it to the decimal point, but they have enough data to know whether inflation will come in at 6 or 6.4 or 5.8. I think they would have a good idea that it would not be way above 6. So in spite of it, the hawkishness, would you say that's important, Upasana?
Lata, I think there are two things to keep in mind. One is clearly they would not have thought of tweaking the inflation readings because there's a lot of volatility.
Yep.
Especially because this downside today also has come because of food inflation. And food has become much more erratic to project. And that is probably the reason RBI would have also kept some buffers with them.
Sure.
If you look at the breakup, core inflation is still sticky, not providing any comfort anywhere. So unless we really get a hang of how food inflation is expected to pan out going ahead, it is going to be a difficult call. So in that context, obviously today's reading does provide comfort because in February, now when they look back, the two readings will be probably sub 6%, which will help them reach a neutral stance. So I see a high chance that we will shift to a neutral stance, but alongside a 25 basis of a rate hike, followed by a subsequent pause. But one important thing I want to highlight is no central bank at this point in time is going to be in a position to sound dovish.
Okay.
I think they will always keep the possibility of additional rate hikes on for considerable period of time.
Okay. Okay, the Informist calculation is that core inflation is 6.1%, by the way. So that means it has inched up from 6% in October to 6.1%. And perhaps the Reserve Bank had that in mind when it sounded worried in the previous policy. Aditi, RBI in February and beyond?
So, Lata, given this moderation today, which is sharper than what the street had expected, of course, keeping in mind that the hawkish tone was there and the door was kept open in the last policy review for another rate hike in February. But I think looking at the kind of moderation that we've seen in the headline inflation today, even though it's been driven by food, I don't think at this point in time we can rule out a pause in February. I think it's going to be a very data-dependent decision. There is another print that's going to come ahead. We'll have the full Q3 average by the time the MPC meets, and we will also have a good sense of how growth has turned out, to what extent demand is actually flattening out, and also what is the impact of the global scenario on our export outlook and the budget as well. So I think there's a huge amount of input that the MPC will have before the February meeting. But looking at the kind of moderation we've seen today, we can't rule out a surprise pause in February.
Okay, now that's big. Will the RBI look at the US PPI or look at our CPI, or will they look at the US CPI number that is yet to come out? I agree, there is more data that Reserve Bank will have to look at, and they did sound worried about core inflation, which has come in higher. Okay, Amandeep, will the market go with a pause at all? Do you see OIS curves also falling?
I think markets would like to believe in a pause at the present juncture. But my sense is that, I think it's a little too early. There was a reason behind RBI bringing in core CPI in its lexicon, on the monetary policy stance. I think, as other panelists have also mentioned, that core remains sticky well into, end of this financial year. So I suppose, like I mentioned, you really can't have household inflation expectations decline if core remains at these levels. So while, there is a fair amount of disinflation, it could be somewhat seasonal. With the food, I see disinflation in food and oil. I also see a very sharp decline as far as year-on-year, growth is concerned on fruits. So we need to wait and watch. A lot of it is still contingent on how some of the other aspects of cereals, spices, milk, etc. Pan out.
Okay.
So yeah, I mean, you do have some benefits. Clearly, markets will start penciling in a revised downward trajectory for headline CPI. But I think core still, no one is expecting it to decline sharply, and I think there is a reason why RBI may want to keep its options open. So I'm not ruling out a potential rate hike in Feb as well.
Actually, this could be the Reserve Bank's thinking. I'm wildly speculating, but Reserve Bank probably knew that the November number is going to come perhaps sub 6, even if they didn't know the exact decimal point, and they perhaps don't want the market to run away with expectations of a pause as early as February, which is why core must have crept into the outlook in the first place. In that para 7 where they extrapolate on their stance, perhaps core made break the persistence of core, figured as a phrase primarily because they perhaps did not want the market to run away with expectations of dovishness on the headline number. I mean, I'm only guessing, of course. Nikhil, your expectations?
So, Lata, we do not change our expectations.
What were they?
We believe there will be at least one more rate hike, 25 bits in February.
Okay.
Because we need to note that the US Fed on Wednesday, it is very likely while they will hike by 50 bits instead of 75 bits in the previous policies, it's very likely that the terminal rate for the US will be revised upwards to 5% or probably 5.25%. And the core inflation, as everyone has pointed out already, it still remains sticky. We do not see any reason for the RBI at this point to believe that there could be a pause as soon as February. It may happen in April, depending on what the global economic growth is like, where India's inflation and global inflation is. But February, we are almost certain that there will be another 25 rate hike.
I'm going to take the liberty of breaking someone's confidence. The SBI Chief Economic Advisor has just messaged me saying that at this rate, if the index moves at this clip, we could have a CPI closer to 5 or even below 5 in February. Then how will the Reserve Bank react in April? It's interesting. I mean, if this clip continues, then perhaps we have a very different April to look at. But that discussion has to be postponed because we don't know whether we can expect this kind of a good run all the while. But this clearly changes the month-on-month and the base on which we will be calculating the index numbers going forward. So this is a very important number, much more lower than expected. Just a word let me get on growth. Rupa, this IIP number, does it change your growth numbers at all? People are, I think, generally working with 6.9 in terms of GDP.
Personally, I feel that we may get lower than 6.9% because, you know, the degrowth shown by manufacturing, mining, etc. in second quarter was also much more than what Street had expected. And, you know, this IIP data, as and when you add more companies' information, even to corporate earning results, you see there is a deterioration of value added coming from industrial sector. So, and then I'm seeing a lot of headwinds, you know. I mean, the pace at which exports are contracting now because of global slowdown. I think that also has contributed to the slowdown because in October, 17% contraction had happened in exports. Certainly that has, you know, and unemployment has become a big issue for India because manufacturing ultimately is the major employment generating sector. So I feel Reserve Bank of India definitely in February, even though they increase at a smaller pace, they will give some kind of a positive surprise, you know, because now the rates are way above neutral rates.
Absolutely. Well, I take your point on growth. Other than primary goods, just about every sub-index has shown contraction, and that would be a little worrisome. Capital goods, basic goods minus 2.3, capital goods minus 2.8, and like I told you, consumer durables minus 15.3 and non-durables minus 13.4. So all the sub-indexes have shown contraction. I mean, the IIP can't be that wrong, is it? Isn't it? So we will have to worry about growth to that extent. Very quickly, I'm really sorry we are out of time. Upasana, will you revise your number, growth number?
Lata, we are at 6.8%. We have a downside bias, but we'll stick to it right now.
Okay. Aditi? Again, sorry, one sentence.
Lata, I'm going to wait for the November numbers to come out.
Fair enough. Nikhil?
Same, Lata, but maximum downgrade could be 10-20 bits, not more than.
You are standing at 6.9, are you?
Yes, currently 6.8, but as Aditi said, we will wait for November numbers to rise.
Bias. All right. We'll leave it at that because you're out of time. Amandeep, Aditi, Rupa, Upasana and Nikhil, thank you very much for joining me. The news from the macroeconomic data is that we have an excellent CPI number, much better than what we expected. And at this rate, it's possible that we will be close to 5% or below in the month of February or in the month of March for that quarter. That would be very positive news for the April policy. But right now, all our economists are going with a possible rate hike in the month of February simply because the core inflation is still 6.1 and that doesn't look like climbing down anytime soon. News on the inflation front positive, news on the growth front almost disastrous with a minus 4.2 IIP number and a minus 5.6 in manufacturing. So bad on growth but benign on inflation. That's it. We wrap up this special broadcast on the state of the economy. Keep it with CNBC TV18. Lots more news and updates follow.